On April 20th, 2020, crude price dropped to negative $33 per barrel. Is this the apocalypse of oil industry? Wait a minute. It's not the crude price. The crude is still traded on positive value. It's the WTI future contract, a financial derivative. What happened really on 20th, 2020? It's a typical Wall Street game. One Chinese bank lost billions of dollars. Now I will try to explain why this happened and what is the implications. Part 1. What is a future? So, future is a contract to buy or sell certain amount of commodity in a specific date. For example, the crude oil producer, in fear that oil price might collapse in the next few months and ruin their business, so they sign a contract with refinery that will sell them part of this production on a fixed price in the future. At the same time, refinery don't want oil price surge that they have to pay too much money buying crude. So they agree to sign the contract with producers. Here's the point. Whenever there's a buy or sell contract, there must be another same contract on the opposite side. If the price rises a few months later, the seller has to sell on the contract price rather than market higher price, so he will lose some money. But anyway, it's still okay, because only part of his production in the contract. If the price dropped significantly, that's exactly the reason he entered into this contract. Vice versa for the buyers. The contract could be signed at any time, even long before the oil well been drilled. On CME, you can buy WTI future in February 2031 by now. Many other commodities or financial products are also traded in the future market, such as food, metal, mineral, stocks, and bonds. So futures are originally developed to manage the risk rather than making extra profit. For buyer or seller who use future to manage risk, we call them hedger. To simplify and facilitate the buy and sell of these contracts, an exchange market standardized the contract. For example, one WTI contract stands for 1,000 barrels of Texas night sweet crude oil. Why call it sweet? Because it was blended with American honey. Because it has no sulfur content. Any contract in the market will make sure you can buy or sell exact the same quantity and quality. 1,000 barrel Texas night sweet crude oil. It's so easy to buy and sell the contract, not necessarily doing physical transaction and delivery. Speculators enter the market to bet the oil price. There are over 1 million WTI contracts trading daily, standing for 1 billion barrels of crude oil, while there are only about 20 million barrels of crude consumed every day by the United States. There are far more speculators than hedgers in the WTI future trading. Part 2. How the WTI future traded in CME. Traders, no matter hedger or speculator, will not pay or receive the whole contract value. Instead, they pay a certain percentage of the contract as deposit, from 8% to 50%. Let's make it a simplified assumption, 10% ratio, and oil price was $20 when the contract is signed. Then, one WTI contract value will be 1,000 barrel multiple $20 1 barrel, total value $20,000. The buyer and the seller will pay 10% of the value as deposit, which was called initial margin in the industry. The amount should be $20,000 multiple 10% equals $2,000. This is the charm of future trading. You commit only $2,000 to trade oil worth at $20,000. Average ratio 10. Someday later, the future oil price increased to $21. Now the contract value was $21,000. That means long, a buyer contract holder earn $1 per barrel. Why? They can use this contract to purchase oil at $20 and sell them to market at $21. His equity is now $2,000 deposit plus $1,000 profit equals $3,000. But for the short or sell contract owner, he has to sell $21 oil by contract price of $20, lost $1 per barrel. His equity now, $2,000 deposit minus $1,000 lost equals $1,000. And now the margin should be $21 per barrel multiplied by 1,000 barrel multiple 10% ratio equals $2,100. Now the exchange will call the short seller to add another $1,100 to the deposit. If this amount was not added, the exchange will sell partial or all the contract to make sure there is enough deposit to cover the margin requirement. On the last day of transaction, the oil price dropped to $19 a barrel. The long contract suffered $1,000 loss. Short contract got $1,000 profit. Now it reversed. There are three options for the long contract holder. First, sell the contract to other trader, but since the trader has to pay $20,000 to get oil worth at $19,000, the contract owner has to compensate the trader $1,000. Second, offer $1,000 cash to the short contract owner to get the opposite contract. The two contracts effectively cancel each other out and get the $2,000 deposit back. Now only $1,000 left, lost $1,000. The seller will get this extra cash and his $3,100 back, total $4,100. Third, enter delivery process, pay $20,000 to get 1,000 barrels of crude, but worth only $19,000, lost $1,000 cash. Part 3. What happened on 20th April? Majority of the traders in CME are speculators, don't have the capacity to receive the physical oil. Normally they will close the contract 7 to 10 days before the last day and purchase contract at a later delivery month. It was called rollover in the industry. By April 15th, when CME announced that they reconstruct the system and it would allow negative oil price, majority of the speculators roll over their contracts. Normally there are less than 10% of the contract remaining outstanding 2 days before closing day, but on 20th April, there are 17% of contracts outstanding, more than 77,000. Means that more than 77 million barrel oil will enter delivering process if position were not covered. Wall Street smelled the blood. Some smart guy figured out that there are less than 27 million storage available in Cushing, Oklahoma, and most of the available space has already been booked by real buyers. There is no available space for speculators to store the purchased oil. Panic started at late that afternoon. Buying contract holders scrambled to cover their position by either buying opposite contract to cancel each other out or sell the contract to somebody else. But the short sellers won't give this chance. Hold their contract tight. The buyer got no choice but to reduce the contract price. Hopefully someone can still buy it. But it doesn't work since no one has the capacity. Then the price dropped to 1 cent per barrel. Still no buyer. Later that day, price closed at negative $37. Only by then, the short started to purchase these negative priced long contracts, got huge profit after hedging them with short contracts in their hand. When the OPEC Plus reduction agreement made on 12th April, lots of Chinese speculators tried to pick the bottom. But several major banks rolled over the contract after CME announced negative price mechanism on 15th April. But one particular bank, Bank of China, still hold estimated 24 to 25,000 long contracts. Loss was estimated to be $1.4 billion. Be careful if you want to get something out from Wall Street. The consequences could be this. Part 4. What is the implication for Nigeria? In conclusion, this negative price is not a supply and demand game, but more about inner trading. The oil price still traded at a positive price, but now the situation is pretty dangerous for Nigeria. Brent oil price today is $26, only $3 higher than the extracting cost in this country, which is $23. It's urgent to diversify its economy, improve infrastructure, and develop manufacturing business to reduce the dependency on crude oil. For individuals, be very cautious on speculating. If you could not understand the game very well, try to avoid it. Future market was extremely dangerous because of leverage. The financial consequences could be beyond your capacity. Same as encrypted currency, such as Bitcoin. Whenever somebody tells you an opportunity to make quick money, his real thought might be like this. Please share your thought on comment. If you like this channel, please subscribe. I will update video every week.